Hello and welcome to this week's episode of Nucleus Investment Insights. Today we ask the question, is the commodity goose cooked? Last year, there were many high-profile commentators saying investors must have commodities to offset inflation around the top of the commodities cycle. We were saying the exact opposite, and that's what's transpired. But where to now for commodities? To answer that question, we're going to delve into the Chinese property sector, which is a massive consumer of iron ore and copper, and dig into the worrying numbers it's recently released. Plus, we'll do a tour of all the other major commodities. Join us today to find out what this means for Australia, geopolitics, and asset markets. Today, as always, we have Damien Klassen, Nucleus Wealth's co-founder and chief investment officer. Damo, welcome.
Thanks, Sam.
Excellent. I'd also like to welcome David Llewellyn-Smith, Nucleus Wealth's other co-founder and chief strategist. Dave, welcome.
G'day, Sam.
Great to have you here. My name is Sam Kerr. I'm the senior financial advisor at Nucleus Wealth. Just a reminder, the information in this podcast is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at www.nucleuswealth.com/contact, and you can book a call with me to have a no obligation chat. We are live every Thursday at 12:30 Australian Eastern Time, so jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform, as our show is available on all the majors. So that's the housekeeping out of the way. So Damo, I'll hand over to you to get the ball rolling.
Thanks, Sam. So yeah, big data dump from China during the week, and didn't look particularly good. In particular, we've been talking for a while about this idea that in late last year, as China reopened, like the markets rallied very hard, particularly commodity markets, with the view that this was now changed. China was going to be back. They're going to be spending all this money and really pushing hard in terms of the housing construction and infrastructure part. And our take at the time was, well, you don't want to stand in front of that train because the commodity prices are rising, and the sentiment was all certainly towards that. So we sort of got rid of all our underweights. As markets rose, though, then we started to go back underweight with the view that, look, China actually really hasn't changed a lot. What they've spoken a lot about it, but actually what's really happening at the ground level is not supportive of these commodity prices. And given that sort of blown pretty close to the largest construction and investment bubble sort of ever in terms of globally, the amount of resources that a country is putting into that one part of its economy, it is well worth sort of doing a bit of a deeper dive. And so, so we're going to have a bit of a look through that. There was a lot of talk. So we'll talk about that. We'll talk about some individual commodities, and then other things that's sort of happening on the market at the moment. But I might start with Dave and some charts on the residential floor space.
Yeah. Okay. So I think Damo's intro was a little anodyne given the scale of what we're witnessing here. This is history in motion. We're seeing what is unquestionably the largest construction, call it bubble, surge, whatever you like, in the history of the world, come a cropper. And so, the implications are pretty big, given, the scale of construction that China has undertaken for the last, since the GFC really, to house its people under the rubric of urbanisation. And that has run its course. So what's happening? So we'll start with this first chart, which is of floor space starts for residential. Now, we've given you a larger version if you want to skip a page forward to see it, and you'll see the blue line in this is that basically since the peak in 2021, starts are down by over 50%, like 50 to 55%. Sales have crashed as well, not quite as far down, and completions have always like tracked way below both starts and sales in China. And that's a bit of a mystery, but we assume there's a kind of ghost inventory in developers that isn't counted appropriately, where they sort of have built these thousands, like tens of thousands of condos, but not released them or not fully completed them and released them in such a way that they get counted in the statistics. So be that as it may, what you can see is that the starts by floor area volume have absolutely cratered and are now, I think April was like the lowest month since 2008, excluding the early months of the year when it's quite low, and so that's a rewind obviously of 15 years, and there really is kind of no end in sight to this, because we've got some attempts to kind of resuscitate property sales and things, but the developers that make these towers, for the last 2 years have been hammered by Beijing. So this is all quite deliberate and therefore structural on their funding side. So they can't leverage anymore and overbuild, which they've done before in various house price cycles. They've then borrowed madly, built ghost cities, and then tried sort of held them and sold them later. Well, that's finished. We've talked about the red lines policy against leverage for a couple of years now, and it has generated this huge crash. So despite the fact that we've got this kind of immense downdraft in construction, it looks like Chinese growth is still okay, because like everybody else who's come out of COVID, they've got something of a mad services boom going on, and so they're going to reach their growth targets anyway, and so there's no kind of immediate need to stimulate their way out of this, which is another reason to sort of think this is something of an L-shaped recovery that's underway for property, at least.
Actually, it's worth saying that as well. From a construction point of view, you could, if they halve their current construction again from where they are now, that would put them back to about where a normal economy would be running. So that's right. Like the boom was sort of running four times bigger than a normal economy. And so, if you come down 50%, if you come down 75% in total, that'll put you back to about normal.
Yes. So we're still in a boom.
Yeah, exactly. Yeah.
Which is crazy. And we don't dig into the demographic profile in this presentation today, but urbanisation itself is now slowing dramatically. It's reached a point, well past the tipping point in terms of numbers per year, and they build out ahead of it, basically. And so, they could almost stop building apartments, continue with urbanisation for another decade, and they wouldn't need a whole lot more other than replacement.
And population's going backwards.
For old stock, and population started to shrink, and working age, etc. So this really is shaping up as the greatest kind of construction bust of all time that will run for a long time yet. So the second chart here is also worth looking at. I mean, it's you got to take all of this data with a bit of a grain of salt, because it's Chinese and it's a bit black box, and so we take it more in terms of trend than necessarily position.
And it doesn't add up as well. The under construction, you'd think the under construction is basically whatever you have under construction plus any starts minus any completions, but it never adds up.
But the index does include in its data package a floor space or a floor area under construction figure. So that's the stock, not the flow. And that's, if you move forward again, you'll have a full size chart of this one as well. You'll see that this sort of stock of floor space under construction has really risen relentlessly since the WTO moment in 2003, but then really went berserk, around the GFC. Took a breather around 2015 when China sort of tried to stop this part of its economy once, and then freaked out and reversed, and then did another, kind of 6 years of crazed construction that it probably didn't need, bearing in mind that it was actually itself declaring that it was building too much 15 years ago and has persisted with it nonetheless. But you'll see in this chart that the last 2 years, since the huge kind of COVID surge in building, floor space under construction has shrunk. It's kind of down about 8 to 10%. And so it's obviously lagging starts, which is the flow, by a long, long way. So as I say, I don't take this as rote in terms of, the magnitude of these things. As a trend, it does give you some notion of, where we are in terms of the amount of activity on the ground as starts fall away. That is, we haven't reached the bottom in terms of, the activity that will actually be undertaken. So there's more downside.
And if you took it from this chart, where we've only just scratched the surface,
Oh, that's exactly right. Now,
as I said, 8 million.
Yeah.
Whereas it should be 3 or 4.
Yeah.
Less than that, probably 2.
Like, I mean, who knows with this data, but I think in trend terms, there's a long way to go. Yes. So, are there any offsets? We'll move to individual commodities once we've kind of been through this profiling of the crash of construction. Yes, there are some offsets. I mean, for the last 2 years, as this phenomenon transpired, there's been a lot of infrastructure building. I've included a chart here that's showing that, but it is also now rolling over. And one of the reasons for that is that it has the same problem as the residential construction. That is, it's massively indebted. It's run out of good projects. It no longer covers its own, debt funding costs. And so it's building for kind of roads to nowhere for its own sake rather than for economic gains and productivity. And so it's running out of headroom. And so, for a number of years, despite pushing this infrastructure surge, Beijing has also had its foot on the brake, telling local governments to not build, not get over leveraged and build too much. And in addition to that, the local government's very reliant from selling to developers for the former boom in residential, and that's crashed. And so they're short of money as well to build infrastructure. And that's the second chart that I included here is land sales and how far down they are. So, when somebody says they'll build, there'll be more stimulus to try and soak up this demand hole that the declining property has produced. Well, yes, but it's also a shrinking lever for them to pull. And if you flip forward one more chart, you'll see I've included this is the quota for local government special bonds, which are used for infrastructure. It is being pressured by Beijing this year as well. It's down. The quota is down 5% for this bond issuance, and in fact, last year had a bunch of special issuance as well, so it's actually going to fall quite a bit from here. So we're also going to see infrastructure activity shrink, in the second half of the year. So I don't doubt that they will stimulate this a little more, but again, it's bumping its head against the ceiling. As well, they're really starting to target a lot more soft infrastructure in these programs, which are less commodity intensive. So more like public services, health, these kinds of things. Tech particularly as well, and so it won't be as commodity intensive as it has been in the past. So basically what I'm saying is I don't think it's going to be enough to offset this property downdraft. There are a few other things. They have gone back to some shantytown renovation, which they haven't done for a few years, and it's a bit of a desperate measure because a lot of that stuff, was suspended a few years ago because of just mass corruption in it. And so, they're going to, throw billions more at that as a way of kind of keeping this construction thing from falling apart entirely. But again, it's too small. And as I say, a lot of that disappears into graft anyway. And there's also been a fair amount of investment, into fixed asset infrastructure, for the private sector following the COVID export boom. But that too is hitting, some pretty serious headwinds with the global economy, suffering quite a lot of slowdown coming out of all the rate hikes and inflation, of course. And I expect that to get considerably worse as the US and Europe go into recessions as they fight their inflation problems. So that component of fixed asset investment is also going to fall away. So it's
actually, if you look at the some of the sort of early warning stats in terms of the number of containers coming out of China, that's fallen quite dramatically over the last little while as well. So like we're already seeing signs of quite a big slowdown in terms of the in terms of goods demand, and we haven't even sort of hit recession stages yet.
Yeah. Okay, so what does all this mean? I have to, give Zoltan Pozsar a bit of a quick slap across the face. You may recall through a lot of last year, he was a Credit Suisse analyst that was telling us that we were looking at the greatest commodity boom of all time, super cycle. Goldman Sachs has been on this as well, owing to the Ukraine war. And we were quite skeptical of it from the outset. And I've just included a chart here of the Bloomberg Commodity Index to show, when they were arguing for this, we were really at a peak that has now come off, considerably, but I think has a lot further to fall because, they really did not factor in the fact that China is going ex-growth here. And without China, you don't have commodity demand. It's really as simple as that. Sam, you want to flip to something there?
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
So in the second part of this presentation, we're going to look at some specific commodities, both industrial metals and energy. And we'll kick off with what we think will be the big one, which is iron ore. And you can probably extrapolate anything we say about iron ore to coking coal, and in sympathy, maybe thermal coal as well. So those three are an enormous component of Australian resources to China. So, we'll get to the implications for Australia, but they're not going to be too good. So, at the peak, Chinese residential construction was probably around a third of Chinese steel consumption. There are various estimates, that flop around between 30 and 40%. So it's a huge component. Who knows exactly how much that's come down yet? It's somewhere between the 10% of construction floor area under construction at -10 and starts at -50, but there's going to be more to go. Now we have seen a material hit to Chinese steel production. It's down, about 50 to 60 million tonnes since the 2021 peak. But a lot of that, in fact, the most of it, has so far been absorbed rather than through blast furnace production. It's been absorbed through steel recycling, that is scrap metals. So, this is contrary to policy, which is, actually since the last 5-year plan has been aiming to generate more steel recycling, and in fact has almost since the announcement of it generated less, and that has absorbed a lot of this downturn so far in steel production. And so that there's a chart in here also for pig iron production, and that is blast furnace output, which is the iron ore demand center. So it's still kind of hovering around, the highs that we reached, around first in sort of 2020, 21. And so it's been protected by this big downdraft in recycling. However, they have continued to build lots of electric arc furnaces, recycling furnaces, and they're still coming on stream owing to policy. And so there's this very strange kind of tension between the impulse to get away from high carbon output steel for obvious reasons, and the fact that steel mills themselves are still using the blast furnace production more than they're using the new age stuff or lower carbon output steel. I don't know how that tension will resolve. All I can say is that there are that it exists, and it's getting worse, not better. There's a lot more EAF or electric arc furnaces stuff coming, and that tension is going to be hit by what we've described as a further downturn in steel output. I don't know how much it'll be, but I'm going to throw the figure of 100 million tonnes out there over the next few years. And if the absorption of this adjustment continues for scrap, then China will have to shut its entire steel scrap industry to maintain the current level of blast furnace output, which seems to be extraordinarily unlikely given the pressures for decarbonisation. So what that means is we're going to see pig iron production fall in the years ahead, and I think this is coming, sort of in the second half of this year. I would expect it to accelerate,
and also costs as well. I guess there's a short term. There's a short-term benefit from shutting down some of your steel recycling in that it's more energy intensive in terms of your costs, but the actual overall cost to recycle steel is much lower than getting new steel. But you can see why there's potentially a short-term argument in terms of commodity prices are booming. Energy prices were booming the Ukraine invasion, and with that type of environment, you want to try and keep energy prices as low as you can. And so there's an argument for saying, okay, well, you're flipping around, but as a longer term argument, there's certainly I've never seen a longer term argument that argues that you're better off starting with fresh steel all the time.
Yeah, and I should add, you can actually put some scrap into the blast furnace as well. So this is not a pure set of charts either. You can increase the proportion of scrap that you use in your your basic oxygen furnace, and so that could hide some of this downdraft as well for pig iron output. So finishing off iron ore, I've obviously got $20 iron ore up there as a scandalous metaphor for what is transpiring. I've been kind of throwing that one around for 10 years or so as we've been waiting for China to get on with this transition and adjustment. And it's just the long-term, inflation adjusted price for iron ore is $20. It's probably $30 now for the break even for the majors. I do not know how long it will take for us to fall to that sort of level where we're at the highest cost marginal producer in iron ore. All I can say is that it looks very much like we're well past the peak in steel output. It was in 2021. They're fighting against a receding tide. there's massive overbuilding in scrap steel. So, the potential for overproduction is real with falling steel prices. And so, all the ingredients are in place for a major fall in the inputs for steel. When it precisely happens is difficult to say, but with all those factors that we've already described, combined with what we think is base case for global recession starting sometime in the second half of this year, maybe running into next, there's a very good bearish argument for iron ore at this point. It's still very expensive, hovering up around $110 when, if Chinese steel production is going to come down this far, then the marginal cost producer probably needs to be down somewhere below $50. This is not a forecast, but it is an intuition, if you like. So I'd be very cautious around iron ore miners. So we're throwing over to copper next, and Damo, you're going to have a crack at that.
Yeah. So I just wanted to talk through. There's obviously, there's been a large push over the last couple of years for people to say, got to get copper. There's this huge transition to electrifying everything, and so therefore, copper is going to be this huge beneficiary of it. And one of the arguments, or a lot of that argument, comes from this chart. This is sort of the grain of truth at the heart of this, which is, electric cars need way more copper than conventional cars, and so that's sort of been the large thing that people have been using to push it. If you look at also the extra copper that's going to be needed in terms of having to produce potentially more transmission lines, more solar, more wind power, all that type of stuff. You can come up with these charts that I've got here, which is showing the growth in copper from sort of 300,000 tons to, depending upon how bullish you want to be, but you can get some of the faster transition ones. You can get up to 1 million tons of copper. So sort of needing 3 times as much copper for green demand as what you did prior. And so that all sounds really, really good for this long-term growth in copper. But you need to put that into perspective. So I've got another chart here which is showing the actual amount of copper production, both from mines, which is sort of the bluer part, and then the shaded part is copper recycling, and that's all on the right there. So we just spoke, get 300,000 tons up to 1 million tons. Well, there's over 30 million tons of total copper production every year. So we're talking about literally a drop in the bucket. Like we're talking a very small part of what is a very big market. So and the issue we've got drives straight back to what we're talking about on those prior charts, is that the biggest consumer of copper, one of the biggest consumers of copper is the Chinese construction market. And so a drop in the Chinese construction of 50%, say, would actually put us back. You need now less copper, even if you went to the most aggressive scenarios for all those ones we're talking about. Now you actually need less copper, because the amount of copper, you're going to save way more than 1 million tons of copper from the Chinese housing construction. And you can see as well, like that we sort of doubled the amount of copper from the 2000s up to today, and most of that was due to China in terms of that huge construction boom that we've had sort of going on there. Next, it's worth noting, within any commodity, you really need to look at the amount of investment that's going into it. I mean, so you want to know the costs of production, and you want to know the amount of investment that's out there, because in my view, commodities will come back to that cost of production, and that's where Dave was talking about, when you get too much on, you need to actually start knocking suppliers out. So the demand can be volatile, the supply is not volatile. Supply takes a long time to come on and a long time to drop off, and so you need to get it down. You need to get the price low enough that people start closing their mines down. And for iron ore, that's probably $50 or below. For copper, in terms of thousands of dollars per ton. You're talking sort of maybe $5,000 or below before people are going to start thinking about it. But it's also worth noting there's a lot of new copper. There's a lot of been a lot of new spend in the last couple of years, and that sort of takes time to flow through the market as well in terms of expansions. And so if you look at sort of a long-term real price for copper, my take is that at $10,000, you definitely want to be selling this. At sort of below $5,000, you might be thinking about buying it. That's probably your lows, and somewhere in between, which is basically where we are now. If you're on a bullish world economy is growing quickly and uses for copper are increasing, you might want to be buying it. But I think we're actually sort of headed the other direction, given recessions and the slowdown in Chinese property. Is that it doesn't look attractive at the moment. One metal where it does, I guess the story is better is the lithium side. Now we've dealt with that a couple of times, but I just want to hit on some of the key points for lithium. First is we need lots more lithium to fund all these batteries, to supply all these batteries. Now there are other options for different, as every day there's different technologies coming out that don't use as much lithium, but the reality is at the moment it's the one that's working is lithium. Now, so we need lots more lithium. The thing is, we actually have lots more lithium. I've just got the supplies here. So Greenbushes, which is the Australian mine, which is one of the largest operated mines in the world. You can see sort of sits way down on this chart of the amount of reserves and resources that's out there. So the salt flats around Bolivia and in South America have got more than enough lithium if that's the if we get there in terms of the production. The issue with lithium is we've actually had two really big cycles just in the last not even 10 years. So we saw lithium prices run up to almost $30 a kilo, US dollars a kilo, before falling back to below 10, and then rising to sort of $80 or $90 a kilo, and then it's plunged in the last little bit back to sort of that $30 to $40 range. But it's been a volatile ride. So if you're a producer of this, there's basically two different types of producers. You're a hard rock producer, or you're producing with brine. I've got a chart up here which is showing what's called the cost curve for miners, and each bar on this represents a mine. And so the really wide bars are the big mines, and the really small bars are the smaller mines. Now, all the ones you can see to the left that are in sort of reds and blues, they're the lowest cost operators, and they're all almost all of them are hard rock. The ones you see on the right with the green and the orange, they're your brine. So effectively, they're the ones for the salt flats, sort of pumping the water through. So the issue for anyone who's a producer or has a mine for one of these is that at $5,000, if you're a hard rock producer, it's fine. You're going to make you make money. You might maybe be break even at that point, but you're not going to go broke. Whereas if you're doing the brine, you could go broke at $5 a kilo. And if we're just sort of jumping back to that prior chart, so we're in the middle of this massive lithium boom, and if you're a brine producer from 2019, sort of mid 2019 to sort of mid 2021, you're probably losing money and thinking about whether you'd be shutting down or not. And now you're minting it, like everyone's at even at where we are now after a drop of sort of 60% in the last couple of months, the guys are still making massive margins in terms of this lithium. But the issue is, it's the question about how do you make a decision about what to open and what not to open. And so we're sort of this in a big picture sense. What's happening is I've got this sort of supply versus demand chart now with some forecasts from people about how it's going to grow. And the growth is going to be massive in terms of the amount, but the issue is there's this balancing item of demand and supply. And so if demand grows by 30% over a couple of years, and supply also grows by 35%, well, actually prices might crash because now supply is greater than demand. But if the next year, demand grows at 30% again, but now supply only grows at 20%, now prices are booming again because there's this mismatch between supply and demand. And so what we're talking about is this quite, there's very small changes in whether mines go ahead or don't go ahead are going to have some outsized effects because of the massive growth we're talking about in this industry. So lithium, just in broad picture sense, below $10,000 a ton or $10 a kilo, you want to be thinking about buying this. Where we are now, $30 is on the high side, but could prices go higher? Absolutely. But I think in the longer term, somewhere around the $20 sort of on an inflation adjusted basis is going to be about the right price for that commodity. And the other thing I wanted to do let's jump to you, Sam, before we do oil and gas.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
So oil is a similar story, not in terms of growth, but it's a similar story in terms of it being, as with all commodities, the production is quite fixed in terms of people have set up these wells. That's what they're running. They've spent the money. They're going to keep producing unless they have to shut it down. Whereas consumption can bounce around a bit more. So I've got a chart up here just from this is from the US EIA, just looking at the amount of production versus consumption, and consumption's been quite low. As you can see, there's been this gap between production and consumption in recent months, and so the implication is, which is why the implication is that there's been building this stock between the two. They're sort of forecasting that consumption is going to catch up and production is going to keep rising and off they'll go. Actually, the other thing I should say about oil, though, as well, which is very different to other commodities, is other commodities do tend to if you've got an iron ore mine or a lithium mine or whatever it is, whatever you produced last year, you're probably going to produce a similar number the next year and maybe even look to try to increase the amount of production until the mine runs out, and then it stops. Whereas within an oil well, the amount of production each year usually drops off, and in particular, the shale well drops off quite substantially. So you do need to the producers need to keep spending money in order to keep production at a higher rate. And the benefit now of the new sort of world order is that what we have in terms of shale oil is they actually drop off so quickly that they actually need to be reinvesting, on a 2 or 3 year basis to keep these oil wells going. So what that means is actually production is probably a bit more flexible than what it used to be in prior decades, because the shale well guys can bring on production quite quickly if prices demand it, and they can also, because they tail off so quickly, they sort of naturally run off the amount of production if they don't produce. Now the big issue with oil is, what is the future? What does the future look like? Now this is a chart from the IEA this time, the Energy Organization, and they're just sort of looking at what the stated policies are, and that's got oil consumption sort of growing as per that prior chart we just put up. If you look at the announcements and the pledges that they've made, then oil's basically going to go sideways. And if you look at what's needed for a net zero scenario, and then oil's got a long way to fall in terms of production. So pick your phase of that. I do think it's worth noting that if I was going to pick a direction for oil, let's say it does reach net zero, is that it's not going to reach there in a straight line. It's going to hold up and then tail off and drop away quite quickly at the end. And the reason for that is because even if you switch tomorrow to every single new car that's sold is an electric vehicle, your existing fleet will take a long time to fade off. But then eventually it'll at the start you'll go, okay, 1/20th of the fleet is now electric, and the rest is 95% running off oil, and then gradually as you tick on, when you start getting close to the end, you'll start getting quite big drops in terms of the fleet that's coming off. Okay, but that's all a bit of a by the by. So that's your sort of medium term view. You pick your outlook in terms of how you want to manage that decline. The bigger issue though is recessions. If we go into a recession, which we think we're pretty likely to, then in almost every scenario, oil demand drops quite precipitously. And when it drops quite precipitously, you usually need prices then to fall in order to take off the supply, new supply. And so, we can sort of see this as sort of the pandemic probably overstated in terms of the amount that came off, because it was a very particular type of recession in terms of everyone shut down and locked at home. But you can see within those, the last couple of recessions have either been have been relatively negative in terms of the growth that you're getting. Sort of falling from 3 to 4% a year to negative numbers, and with those, that makes a big difference to that net balance, and can make a big difference to the prices. Dave, I'm not sure if you've got anything else you want to say in terms of oil and gas. Even we didn't really talk too much about gas.
I guess I'd just add that gas, having had this Ukraine war boom, is going bust, and I expect it to continue. So that's another big blow for Australia's terms of trade. There's a glut of gas, in short.
Okay, excellent. So now
Sam,
now we have our question of the week. So this is for viewers to have some discussion in the comment section over the coming days. The question for this week is it the end of the line for commodities? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And back to you guys for the investment implications.
Okay, so we're quickly going to run through what this does to Australia if we prove correct, and there's material further downside for the key commodity prices. People only really need to think back to 2014-15 to understand it. When the commodities fall this far, then basically Australia takes a giant pay cut. That's called the terms of trade falling. It's very deflationary. It hits the budget hard. It tends to hit the stock market quite hard, and it filters through to wages as well. So it's very deflationary. And then you get a double whammy because the budget tries to repair things with higher taxes. And so you get lower GDP, and you're already working with much lower nominal GDP because income is so challenged. I would expect Canberra to respond to this with, you guessed it, mass immigration. And so, it is a deflationary scenario, heavily so, but if that's what Canberra does, as it did after 2015, then there are areas of inflation in the Australian economy driven by immigration that might persist. On one side, well, first we've got the gas cartel, which is just an ongoing problem, but then you've got, this problem with rents.
Actually, I might just define quickly that gas cartel, Dave. Basically, what David's talking about is we're paying effectively the highest prices in gas for gas in the world, despite the fact that we're the biggest exporter of gas in the world. Oh, sorry, on the East Coast. On the West Coast, we're not. West Coast prices are low.
Domestic reservation in the West and none in the East. but somehow that logic does not make it across the border. So, you know, I think net, it's probably a deflationary outcome for Australia. It certainly was for a decade after the 2012 bust in commodities that took, you know, a good 10 years to play out. So, but there will be these pockets of inflation as well. And if you get, you know, energy and rents going up while you have weak wages, then you're going to have a real political problem. So possible political instability. This is where I want to get kind of this, you know, what does this story of the Chinese construction bust mean for geopolitics? Give you a glimpse of the scale of what this means. In effect, it means the Chinese growth story is over. This is China going X growth. Property has been the key dimension of its outsized growth for the last 20 years. 30% roughly of the economy growing at a crazy rate, as Damo suggested, far more strongly than any developed economy, and it's just going to keep winding down with all of its population problems. And so this is, you know, kind of the Michael Pettis moment, if you like, where, you know, China's debt charged growth is going to meet its maker, and China's growth is just going to slow down perpetually from here. So that means it can't really support rising living standards to the degree that it has in the past. And we're already seeing this in youth unemployment, which is now at nearly 21%, which is...
And that's reported.
And that's reported?
So China's, you know, there's various things about, you know, whether they've been, you know, underestimating their unemployment rates for years.
Yes.
But so for them to actually come out and say, yeah, 20+% of their youth is unemployed, potentially it's a lot higher than that.
So the Chinese Communist Party has known this for many years, as we intimated earlier in this presentation. We were talking about, Li Ka-ching or Li Ka-ching, I can't remember his name now. He's gone now, the former president. You know, he was warning of this overbuilding in 2008.
Yes. At building levels that were probably slightly lower than where they are today. He was warning that it was unbalanced and they're building too much.
And Xi Jinping has always been very strong on this point as well, where he wants to move away from fixed asset investment to drive growth and towards, you know, consumption and productivity growth, you know, to drive incomes. So, you know, China, and this is where you come back to the point where Beijing has done this deliberately. But, you know, at this point in the development of emerging markets, you have two choices. You either liberalize further and let further control go of the economy, decentralize it, privatize the shit out of everything, you know, boost capital efficiency, give households a go at owning stuff, and get rising incomes in the private sector, and you can continue to grow quite, you know, reasonably quickly, much more slowly, but reasonably fast, and absorb, you know, your excess labor. Or, you know, you go the other way, which is repressive, and you centralize further, and you have to start to crack down on your population much harder, because you've got more unemployed, they're more restive, rising living standards aren't rising, everyone's getting the shits and getting angry with the government. And obviously in China's case, because of the nature of the CCP, they've chosen the latter path. You know, they can't liberalize further because it would effectively be destroying themselves. And, you know, that's not what they're about. They're about self-perpetuation. So, you know, this is kind of a historic choice that's been coming to China for years and years. The CCP has known it, and I would argue that they actually made this choice when they elected Xi Jinping to the leadership. So it's not Xi Jinping that's driving this. He is a symptom, not a cause. He is the symptom of the choice that they had to make in the nature of their development path. And so that means, what else for everybody else? And obviously it means, you know, life's going to get tougher for the Chinese, but it also means it's going to get tougher for the rest of us, particularly Australia, because, you know, as we've seen, you're going to see a rise of militarism and nationalism as a tool for social control in China. In other words, the legitimacy of the Communist Party will shift from prosperity to national security. And that's a political trick that's, good old-fashioned political trick, been used many times before. And, China's well into it now. And so the more Chinese property slows, the less it can grow, the less it can provide prosperity to its people, the less legitimacy the CCP has, the more aggressive it must become. And so you can see where these factors converge at a possible trigger for a Taiwan invasion, in fact, depending on how quickly it happens, how badly bad the economy goes, how much it stalls. That to me is the prime trigger for invading Taiwan, nothing else. That's the main one, is that the Communist Party needs to make an excuse for itself to retain power. And of course, if it does that, I would expect, hopefully we wouldn't be silly enough to have a war over it, but I would expect for China to be effectively kicked out of the global economy, a la Russia and its invasion of Ukraine. So this is how big this construction bust is. It is massive for the global economy, for geopolitics, for Australian politics, for peace on earth and everything else.
Excellent. So Damo, have you got anything else to add on the investment implications there?
Well, yeah, let's keep going. I'll let Dave do the implications for asset markets.
There's another slide. Oh my God, I thought I finished with that crescendo. All right.
Yeah.
So what does it mean for asset markets? Well, it means there's no China rescue coming to the global economy. Stimulus will be targeted. Arguably, they couldn't even stimulate because they've, virtually bankrupted their deleveraged development sector and they can't get the debt. Commodities keep falling. Australian dollar remains under pressure as a commodity currency. I would expect Australian stocks to underperform global stocks. And because ultimately, I think in net terms, it's deflationary, combined with this kind of, global environment of slowing growth, then I think bonds are a good haven.
Excellent. Okay, nice one. So I just want to let the viewers know as well. We do have we have around 100 different screens and tilts, which you likely heard in that little sales message. And, there are some ways that you can play this within your portfolio. So just a couple of ideas, some examples. You can exclude fossil fuels or you can include oil and gas stocks. If you think there's going to be a recession, you could add some extra defensive stocks or extra quality stocks. And then on the other side of the coin, you could exclude some Australian banks or consumer discretionaries. So there's lots of different ways you can play these investment themes. So go to nucleuswealth.com. You can jump in the portal, have a play around in there and use them within the portfolios or as standalone portfolios as well. So that pretty much wraps us up today. So thanks, Dave. Thank you, Damo. I'm sure everyone's looking forward to the next installment of this unfolding China story. We have been talking about it for a number of years, and it's likely going to continue for many years to come. Excellent. So if you enjoy our content, subscribe to our YouTube channel and click the bell below to be notified on any new special episodes or future content. Also, like the video now, and if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you please share it with them. We do put out a lot of other content in addition to this podcast. We write regular articles that are featured in the AFR, the Australian, First Links, and many other major publications. April performance is also out, so subscribe at nucleuswealth.com and you'll get our weekly Nucleus news and investment insights. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop in the comment section below or send us an email at contact@nucleuswealth.com. Additionally, if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.